Analysis investors worry that U.S. profit forecasts are too excessive. New York concerns are developing that U.S. corporate profits are increasingly at hazard from dizzying inflation, a strong dollar and growing hobby costs, complicating the outlook for buyers already reeling from the S&P 500's bear market affirmation earlier this week. While second quarter profit increase forecasts have fallen in recent weeks, estimates for the 0.33 and fourth quarters and for all of 2022 have held up or risen, consistent with IBES records from Refinitiv. As of Friday, Wall Street analysts predicted S&P 500 income to grow via 9.6% in 2022, up from 8% on the begin of April and from 8.4% on January 1. Strategists fear the one's estimates are not going to keep up. Many expect greater bad outlooks from U.S. groups inside the coming weeks and said that steering will then be meditated in consensus profit increase estimates. Most S&P 500 businesses will report second quarter income after mid-July, and software massive Microsoft, Nasdaq, MSFT, and retailer Target, NYSE, TGT, had been many of the agencies issuing dour outlooks in recent weeks. Estimates are too excessive, and you will see them start to come down because the second quarter numbers come out and as organizations talk about what they're seeing, stated Peter Tews, president of Chase Investment Counsel. Falling earnings expectations should spell more problem for a market that has been pummeled with the aid of concerns over how an uncompetitive Federal Reserve response to surging inflation could hit growth. The S&P 500 completed Monday greater than 20% under its record closing excessive, confirming the index is in a endure marketplace, consistent with a generally used definition. The drop followed stronger than expected inflation facts closing week that ratcheted up expectancies for how a great deal the Fed will need to tighten economic policy, a good way to tame customer costs. The Fed on Wednesday raised costs via 75 basis points, its biggest growth considering that 1994, and has now extended borrowing expenses by a complete of 150 basis factors this year. Worries that corporate income are wavering may want to bolster the argument that stocks remain richly valued, even after their sharp decline this year. The S&P 500's ahead 12-month price-to-earnings ratio stood at 17.1 as of Friday as opposed to 22.1 on the give-up of December, however become still above its long-term average of about 16, Refinitiv statistics showed. Challenges dealing with U.S. organizations consist of a stronger dollar, which becomes stated by means of Microsoft, while the software maker reduced its fourth quarter forecast for profit and sales in advance this month. A stronger dollar typically eats into the income of agencies that have global operations and convert foreign currencies into dollars. The U.S. foreign money is up about 9% so far this year and close to a two-decade excessive against a basket of its peers, pushed with the aid of expectations of higher U.S. prices and heightened geopolitical tensions. After Microsoft's announcement, traders will be listening for what other software program and tech companies like Adobe, Nasdaq, ADBE, Inc. and IBM, NYSE, IBM, have to mention approximately currency problems in upcoming reviews, said Daniel Morgan, portfolio supervisor at Synovus, NYSE, SNV Trust. Adobe is due to launch second quarter results after the bell Thursday. Also carefully watched could be stores and different customer discretionary agencies that have struggled beneath the effects of surging inflation. Shares of Walmart, NYSE, WMT, and different huge shops took a hit last week after Target cut its quarterly income margin forecast and stated it should offer deeper discounts to clear stock. Other demanding situations consist of sky-high oil charges and growing interest quotes that have weighed on tech and increased shares, whose valuations heavily rely on future coins flows. Recent COVID-related lockdowns in China can also take a toll. We count on the electricity crunch to hit boom and better exertions prices to eat into earnings. The hassle. Consensus earnings estimates don't seem to mirror this, analysts at BlackRock NYSE Block wrote in a latest word on why they may be no longer shopping for the dip in stocks. To make certain, even as patron spending is moving, it does now not seem to be slowing, said Steve Desinctis, small and mid-capitalization equity strategist at Jefferies. That might also recommend a few stores could advantage from changing customer conduct, whilst others experience the pinch. At the equal time, investors can also already be pricing in anticipated hits to income given stocks' current tumble, stated Christina Hooper, chief worldwide marketplace strategist at Invesco. The query becomes whether or not it comes so rapid and furious that it absolutely shakes marketplace self-assurance even similarly, she stated.